Okay, we are getting started. Thank you, everybody, for joining me on this exciting class about long-term care insurance, especially in light of what's happening in the industry. We're going to just give it a few more seconds. I see more people are entering the room, so I'm just going to give it a few more seconds so people could join us. Fantastic, fantastic. Really appreciate everybody here being on time so we could get started on time. Really, really appreciate it. Looks like more people are joining the room, so just going to give it a few more seconds. Amazing, amazing. All right, looks good. Looks good. Welcome, everybody. Thank you so much for joining me. We're going to talk today about long-term care insurance, and we're going to frame it in context of what's happening with the federal long-term care insurance program. But before I dive into the material, the first thing I want to do is say a thank you to my clients and my members, the ones who support me. As I always say, these classes do not happen in a vacuum. They happen because there are people who are supporting me. So if you know somebody who's one of my clients, one of my members, can you give them a hug from me? And you should give them a hug for you as well. And if anybody here is interested in becoming a client or a member, you can request a meeting with me. I'm going to show you guys how to do so. On the side, you'll probably see a button pop up just now on the side. You'll have the ability to request a one-on-one with me. So if anybody here has an interest in talking with me about long-term care insurance or about federal benefits or about overall financial planning, by all means, you can reach out for a meeting. Thank you very much for that. Okay, now let us dive in and first explain what's happening in the long-term care industry. Now, you've heard that OPM suspended the federal long-term care insurance program. This is not just a OPM specific issue that's happening, though. There is an industry-wide, I don't know if I would call it a breakdown, but an industry-wide shift in long-term care insurance. Just to put in perspective, the federal government started offering long-term care, the OPM program, the federal long-term care insurance program, that started being offered in about 2003. At that time, there were about 125 insurance companies offering insurance policies, standalone personal insurance policies, long-term care insurance policies. 125. In 2016, so that is just 13 years later, so to speak, right? 2016, there were only 15 of those companies left. So there has been a major shift, a major truncation of long-term care insurance providers. There's only about, maybe right now there's only a dozen left, or, maybe it's even less than a dozen companies offering long-term care insurance policies. So just so you guys know that what's happening right now is not a specific problem for the OPM, Federal Long-Term Care Insurance Program, but it's an industry-wide issue that needs to be addressed. But I want to talk specifically about the OPM program. It kicked off in 2003. At the time, the insurance companies that were backing up the program, it was a partnership between MetLife and John Hancock. MetLife and John Hancock were the two number one largest insurance companies in America, long-term care insurance companies in America. MetLife and John Hancock, they were both the number one long-term care insurance companies in the country. That contract in 2003, it was supposed to be a 7-year contract, and it was going to come up for renewal in 2011. Well, in 2011, MetLife bowed out of the contract. They left the contract. Now, what people didn't notice at the time is that MetLife didn't just leave the contract. They left the entire long-term care insurance industry. If you contact MetLife and you say, MetLife, take my money, I want to buy a policy from you, they'll say, I'm sorry, we're out of the industry. We left the industry. They were the number one insurer. The next number one insurer, John Hancock, they stayed with the policy, the long-term care program, long-term care insurance program with OPM. However, in 2019, John Hancock, who was then the number one insurer, they also left the industry. Now, they stuck with the OPM policy. They stuck with the Federal Long-Term Care Insurance Program. But if you want to go privately to John Hancock and say, John Hancock, I want to pay you money. Please sell me a policy. They'll say, I'm sorry, we have left the industry. After John Hancock left, the next number one also left, a company called Genworth. So we have the number one insurers exiting. They're exiting the industry. Now, why are they exiting the industry? So I'm sure you guys have heard, because they were losing money hand over fist. Let's put it in perspective. The long-term care insurance as an industry is actually a very young industry. I know it sounds ironic to say it like that, but the reason why I say it's young is because long-term care insurance really dates back to the 1950s. Maybe you could say there was some hint of it already in the 1940s, maybe 1930s with the Social Security Administration. That's a federal insurance plan. But as far as individual insurance, it's really the 1950s. And think about what was longevity like back in the 1950s. People would be dead by their 60s or their 70s, maybe let's say the 70s. But now we know people are living past the 70s. Some people live into their 80s, 90s, some people age 100. So the stats from just 80 years ago are pretty much obsolete. And so all the new stats, even the stats from 2000, are really outdated because of advances in medicine, advances in technology. So for an insurance company to be basing their models on data, which is 80 years old or even 20 years old, is a very dangerous model in this young industry, as opposed to life insurance. Life insurance has been around for 1,000 years. Okay, long-term care insurance has been around for less than 100 years. So it's a very young industry, and there's a lot of mistakes that are happening. And as a result of that, companies are either learning that they should leave the industry, or they should raise their rates because they miscalculated the original rate, the original pricing. I have some clients, they got the federal long-term care insurance program when it kicked off back in 2003. And I have some clients that have the letter from OPM. They have the letter. And the letter says your rates are guaranteed to never go up. We guarantee to never raise your rates. Well, as some of you may know, they've raised their rates. I believe it's 6 times they've raised their rates. And the most recent rate increase was a 100% premium increase. So what that means is that there are people whose premiums doubled, bang, just like that. And as a result of the premium rising, this has been happening so frequently that OPM is saying, whoa. Okay, wait a second. Wait a second. Pause. We have to pause what's going on over here. And they paused the federal long-term care insurance program. I believe it's for a 24-month period, just so they could figure out whether this is something that they even want to continue with. And if they do continue with it, how are they going to stabilize pricing? So as of now, the federal long-term care insurance program is not even being offered. But just so you guys know, even before they shut it down, there were so many changes. If you guys can see on the slide over here, on the bottom of the slide, they used to offer certain benefits, but then they started cutting them out. As in addition to raising prices, they were cutting out the following benefits. So, for example, they no longer offered simplified underwriting. For those who remember those good old days, simplified underwriting was where they would ask you just 3 or 5 basic health questions. And if you answered no to those questions, congratulations, you're accepted. Whoa. So those days are gone. Those days are gone. And they also used to offer weekly reimbursement benefits. So a weekly reimbursement benefit is actually a more flexible benefit. It's based upon the expenses you incur over the week, as opposed to expenses you incur on a day-by-day basis. So it's a more flexible benefit. It's actually a better benefit, but they no longer offer that. Now they just offer daily benefits. Well, they don't offer anything anymore, but when they did offer it, it was daily benefits. They used to offer an unlimited lifetime benefit period. Now it's a 5-year benefit period as the max. They used to offer an uncapped automatic compound inflation option. That means your benefit would go up with whatever CPI was, whatever the measure of inflation is, the consumer price index. And then they couldn't do that, so they had to cap it at 5 and then 4, and now it's at 3. And as I said, now it's actually at nothing because now they're not offering anything. Whoever has a policy in place, you're in good standing. You're fine. So far, nothing has been done to the existing clients. But for anybody who wants to buy a new policy with the federal long-term care insurance program, it has been suspended. So now you cannot even get long-term care insurance through the OPM program. Now, if you want to get long-term care insurance, you're going to have to go with an outside insurance carrier. So I want to talk about long-term care insurance in general. And I really want to approach it from a standpoint of, do you need long-term care insurance? So let's try to frame this conversation as best as possible. First of all, let's try to get a sense as to how much long-term care, if you had a long-term care event, how much would that cost you? So I have over here the national averages, and these national averages, I pulled them from the government website, LTC Feds, which was the Federal Long-Term Care Insurance Program. And then they also have ACL.gov. So these are government websites. These are the national averages. Now, I know some of you, when you look at these numbers, you're going to be snickering. When I show these to some people in different parts of the country, they laugh at me and they say, "What? This can't be the numbers." Well, remember, these are the national averages. What that means is that in some places it's going to be higher, some places it's going to be lower. The average come around these numbers. So let's see what this looks like. So for home health care, as you guys can see, $21 an hour. For a day in the adult care center, that's $68 a day. $3,600 a month for assisted living. And then $225 or $253 a day for a room in a nursing home. So these are the prices today. But the truth is, these prices are irrelevant to you guys because these are the prices today. And guess what? Today, many of you are healthy. In fact, that's why many of you want to retire now while you're still healthy, while you could still do all the fun stuff before it gets too late. So the truth is, today's numbers are not really what's relevant to you guys. What we need to do is we need to see these numbers in the future. So what I did is I took these numbers and I projected them 25 years into the future. So look what these numbers turn into 25 years from now. Here we go. $71 an hour for home health care. $231 a day for adult daycare. $12,000 a month for assisted living? Oh my goodness. By the way, there are some people paying $12,000 a month now. And then for a day in a nursing home, $763 or $858 a day in a nursing home. Unreal. These are unreal numbers. And let's add it up. If a person had a long-term care event that lasted for some duration, let's see what it adds up to. See, here's an example. Let's say somebody has $71 an hour for home health care, 7 hours a day, because maybe in the evenings they have family members that could come help out. 5 days a week, because maybe on the weekends they have family members that can help out. 52 weeks a year. That's $129,000, and that's just the cost of care. Don't forget there's the other living expenses. You still have your property tax, your homeowner's insurance, your other insurances, your utilities, any medications you're taking, groceries, whatever it may be. So don't forget the regular living expenses of about $60,000. If a person had this type of long-term care event, how long would $1 million last with this type of long-term care event? So as you guys can see, I ran the numbers over here. Let's say you start with $1 million and then you have this long-term care event. So you start off with $1 million, you have the long-term care event, the remainder is $870. You have your money's growing at 5%. So I don't have your money doing nothing. I have your money assumed growth of 5%. You have the cost of living, then you have the remainder, and then it starts again in year number 2. And then again in year number 3, 4, 5, and then into the 6th year, that's when you have exhausted your $1 million. So basically, $1 million could buy you about 5 plus years of some type of benefit. Now, I have good news and bad news, followed by some other good news, followed by some other bad news. So let's go one by one. Let's start with the first piece of good news. As you guys can see, $1 million could buy you about 5 years of some type of coverage. Why is that good news? Does anybody here know what is the average duration in a nursing home? When a person needs long-term care in a nursing home, what's the average duration? The average duration is 2 years. 2 years is actually a little bit less depending upon your gender, right? But 2 years average. So here I am showing you that $1 million would buy you about 5 years of coverage when the average stay in a nursing home is 2 years. That's the good news. But here's the bad news. When somebody needs long-term care, what's their attitude? Is their attitude, quick, rush me to the nursing home right away? No. If anything, they say, the last place I want to end up in is the nursing home. Keep me out of the nursing home as long as possible. So when we say the average stay in a nursing home is 2 years, understand that was the last resort. At first, they got some care in their own home before they ended up in the nursing home. That's the bad news. Back to the good news, though. As you guys can see, if you had $1 million, it would buy you about 5 years of some type of coverage. Might not be nursing home, but of some type of coverage. Now, I know what some of you are thinking. Some of you are thinking, Stefan, that's very nice, but there's just one problem. I don't have $1 million. Now, it's true. You might not have $1 million now, but remember, these numbers, they're not the numbers today. These are the numbers 25 years from now. And guess what? 25 years from now, you're right. You won't have $1 million. You'll have multiple millions of dollars, especially federal employees. Why do I say especially federal employees? Well, because the rest of America, when it comes to retirement, the rest of America, they have their Social Security and everything else lands on their investments. So their investments have to carry them tremendously through retirement. However, federal employees, not only do you have Social Security, but you also have your federal pensions. And because you have those federal pensions, that actually takes pressure off your investments. And because you have less pressure in your investments are actually given the ability to continue to grow. So I have news for you. 25 years from now, you're right. You might not have $1 million. You might have multiple millions of dollars. And as I'm showing, just one of those million buy you about 5 years of coverage. That's the good news. Back to the bad news, though. If you spend down your money on a long-term care event, what's left for the next person in line? If you guys are following me, we have just arrived at the crux of the long-term care issue. The crux of the long-term care issue. The crux of the long-term care issue is recognizing that there is a tug of war going on. You can either spend down your money on your own long-term care, spend down your assets, or you could try to preserve those assets for the next person in line. Again, the tug of war is spend down the assets or preserve the assets for the next person in line. Well, if it's a tug of war between spending down versus preserving for the next person in line, we really should examine who is that next person in line. If you think about it, the next person in line, I could think of 3 categories of the next person in line. And I want you guys to pay attention to these 3 categories. Let's figure out which of these 3 categories do you fit into. So the first category of the next person in line is when the next person in line is not clearly defined. What does that even mean? Well, actually, this is quite common. I have a lot of clients that fit into this category. I have a lot of clients that are single, no kids. Single, no kids. When I speak to those clients, that are single and no kids, and I say, okay, when you pass away, what happens to your stuff? You know what they say to me? They say, I'm sure somebody would be happy to take this money. Maybe I have a sibling, maybe I have a niece or a nephew, maybe there's a charity to leave it to. I'm sure somebody will receive whatever money is left over. Okay, but are you trying to earmark money for a specific person? Do you feel that somebody needs to receive a certain money when you pass away? No, whatever's left over, I'm sure somebody will be happy to take it. Well, if you're in that category, single, no children, guess what? That is the easiest category to self-insure. What do I mean by self-insure? Self-insure means you don't have to pay an insurance company to cover your long-term care. If something goes wrong, it's okay. I'll cover it myself. How? With my assets. It's not like I have nothing. I have my TSB, I have my other investments, I have my bank account. Some of you may even be able to tap into your home if need be. I try to avoid that, but if need be. So if you're in that category, you might be able to self-insure because, again, who are you trying to preserve assets for? Who's the next person in line? If there really is no next person in line, that means you are likely going to have an easy time to self-insure. Okay, that is the first category of the next person in line. The second category of the next person in line is the children. Now, this gets into your attitude of leaving an inheritance to your children. What is your attitude of leaving an inheritance to your children? When I speak to clients, I see there is a spectrum. There is a range of attitudes. Here's one attitude. It sounds like this. Stefan, I received an inheritance and I saw the positive impact it had on my life. And I want to do the same thing for my kids. So, Stefan, in my financial plan, I want you to carve out some money. It is not to be used for me. It's going to be earmarked for my children's inheritance. That's one end of the spectrum. There's another attitude that sounds like this. Stefan, I love my kids. If there's something left over, I'm happy to leave it to them. But if I need the money for myself, I'm going to spend it on myself. I'm not going to sell myself short just to make sure my kids receive an inheritance. If I need the money for me, I'm spending it on me. That reminds me of one of my favorite bumper stickers. Have you guys ever seen the bumper sticker that says, I'm spending my kids' inheritance? I love that. That's a good one. And you know what? I totally get that. I'll tell you why. Because most people need long-term care when? Usually later in life. When I say later in life, in their 80s, in their 90s. Please tell me, if you're in your 80s or 90s, how old are your kids at that point? In their 50s, 60s, maybe 70s even? Hopefully by then, the kids will have their 2 feet planted on the ground. Now, I'm not saying your kids would be unhappy with an inheritance. Why would they be unhappy? Of course, they would appreciate any money that you leave them. I'm not saying that. What I am saying is, if you didn't leave them an inheritance, how detrimental would that be? Well, again, if they're in their 50s, 60s, 70s, hopefully by that point, they're financially independent. If you are in that category is also relatively easy to self-insure because you don't have to preserve money for the inheritance. Hopefully they'll be independent, and if you use the money for yourself, they'll be fine. Which brings us to the third category of the next person in line. The third category is the spouse. Ironically, your spouse may be your longest dependent. When we think of dependence, we think of children, but the children will at some point become independent. We hope. But your spouse, they may be dependent indefinitely. Now, if you ever speak to the spouses about long-term care insurance, you may have detected that the spouses go in different directions. One of the spouse is usually on board with the long-term care insurance, while the other spouse is completely dismissive. Has anybody seen that? If you have a husband-wife, you may notice one of the spouses is totally interested in long-term care insurance, and the other spouse is completely dismissive. Can anybody guess which one's interested and which one is dismissive? That's right. The wife is usually on board. The husband is usually dismissive. Why is that? Why is that? There's actually a very good reason for that. The reason is because guys die first. You guys know that, right? I'm just letting you guys know. Guys die first. So if you ever speak to a guy about long-term care insurance, he'll give you the classic guy responses. There's many of them. I'll share with you guys a couple of them. So one classic guy response is, you know what? If I ever get to that point, I give them full permission to pull the plug. I'm not interested. No, thank you. That's one classic guy response. There's another classic guy response, which is, what? Me worry? What do I need to worry about? I have my lovely spouse here to take care of me. That's what he has to say. What does she say? Well, very good for you. But when I need care, where are you going to be? You're going to be dead. Who's going to care for me? So she's totally on board, and he is totally dismissive. Now, while that's the prevailing attitude when it comes to long-term care insurance, that's definitely the prevailing attitude. However, if you think about it, that attitude is the exact opposite of the way you need to be thinking about long-term care insurance. Because remember, the long-term care insurance is a tug of war. Do I spend down my assets on my care, or do I try to preserve those assets for the next person in line? Well, if we're dealing with a husband and wife, and the guy dies first, which one is likely to leave over the next person in line? Well, if the guy dies first, the guy is going to leave over his wife as the next person in line. That means the guy cannot eat up the assets. He cannot spend down the assets. He has to preserve those assets for his spouse, the next person in line. And yet, that same guy is just so dismissive. So we really have to get into everyone's head, but especially the guy's head. We have to ask him, okay, if you had a long-term care event, we have to plan for it. What are you going to do? Just not plan for it? But let's plan for it. If you had a long-term care event, who is going to pay for that long-term care event? So here are some suspects. Here are some candidates, and let's see if this is true. Number one, will FEHB. Will FEHB pay for your long-term care? No, FEHB will not pay for your long-term care. Not at all. FEHB is medical insurance, not long-term care insurance. And there is a very, very big difference in the insurance world. There's a very, very big line that divides medical insurance from long-term care insurance. What's the line of divide? Very simple. Any care that's designed to improve a person's condition, that's medical care. However, any care that's designed to just maintain the person's condition, that is custodial or maintenance care. That's long-term care. So health insurances do not cover custodial maintenance long-term care. So FEHB is not going to cover your long-term care. What about Medicare? Remember, Medicare is for people age 65. Will Medicare pay for your long-term care? Now, if you read the Medicare websites, the Medicare brochures, they say explicitly that Medicare does not cover long-term care. That's what they say explicitly. But let me share with you something I discovered. So I have a relative that is the controller of a nursing home. He's involved in all the accounting, all the billing. And this is what he told me. Medicare does kick in and pay for nursing home expenses. Yes, it does. But there's a catch. Number one, it has to be that the long-term care was accompanied by a qualifying medical event. So there must be some sort of medical event that triggered the need for long-term care. Now, what exactly is a qualified medical event? That I don't know the exact parameters of. But it has to be accompanied by a qualified medical event in order to trigger the Medicare assistance. And it's limited to 100 days per year. So even if Medicare does kick in, it's limited to 100 days per year, which is something, very important something that might offset your costs of long-term care. But again, it has to be accompanied by a qualified medical event. So hard to say that we should rely on Medicare for long-term care. In fact, I will tell you what Medicare says, which is that Medicare does not cover long-term care. Yes, you'll find some exceptions, but in general, Medicare is not going to cover long-term care. So FEHB is not going to cover your long-term care. Medicare is not going to cover your long-term care. What about Medicaid? Will Medicaid cover your long-term care? And the answer is, yeah, they will. But you know who Medicaid is for? You have to be eligible for Medicaid. And who is Medicaid for? Medicaid is for people who are low asset, low income, basically impoverished. Let me show you what I'm talking about. So again, some national averages, some national numbers. In order to be eligible for Medicaid, just so you guys know that I talk about Medicaid as if it's a federal program, which it is on the federal level to some degree, but it's administered on a state-by-state level. So what this means is every state will have their different qualifications. Some states have an asset test. Some states have an income test. Some states have a hybrid asset income test. Just to let you federal employees know, if you live in a state that has an income test, I'm sorry to say, you may likely never be eligible for Medicaid. Why? Because your pensions are just too big. Now, that's the federal employee. It could very well be that the parents of the federal employee or the spouse of the federal employee, there might be something different. Federal employee, if you live in a state that's an income test, it's going to be hard for a federal employee with a robust federal pension to be eligible on an income basis. On an asset basis, you might be eligible. But in order to be eligible on an asset basis, you have to have less than $3,000 in assets. That's not a typo. 3,000 in assets? Who doesn't have $3,000 in assets? Hello, what if I own a car or if I own a house? My car and my house are worth more than $3,000. That's a very good point, actually. Interestingly, your home and your car, your primary residence and your primary vehicle are usually, again, it's going to vary state by state, but they're usually non-countable assets. So if you have a home and if you have a car, even though those are worth more than $3,000, that's not necessarily going to disqualify you. Those are not necessarily going to disqualify you because those are non-countable assets. Okay? But what I'm trying to impress upon you guys is that if you have other assets, like your TSB, your bank accounts, if you have more than $3,000, you're probably not going to be eligible for Medicaid. Now, with that being said, let me share with you guys something very scary, very scary. If you guys can see this chart over here, Medicaid is the largest sponsor of long-term care in the country. Medicaid is the largest sponsor of long-term care in the country, which begs the question, are there that many poor people? Are there that many poor people that are eligible for Medicaid? And the answer is yes, but first of all, there are many people that are impoverished, legit. Okay, I don't think we really appreciate the numbers, but there are many people who really have very little in terms of assets, very little in terms of income. But then there are other people that have plenty of assets, and yet they're still eligible. I'll give you a case in point. So when I was playing hockey, this is a few years ago, I was schmoozing with one of the people who were playing, and they were telling me about their father. Their father was an elderly gentleman, and he was receiving long-term care. It was being paid for by Medicaid. Now, it was very surprising to hear that this person's father was receiving Medicaid assistance for long-term care. Why was it interesting? Because this person's father was a successful cardiologist in Manhattan, in New York City. Let's just say they were very well-to-do. So I looked at this friend. I said, your father, Medicaid? How? They looked at me and they said, Medicaid planning. What does that mean, Medicaid planning? So if you're not sitting down, you guys may want to sit down for this because like this, your jaw is going to drop. This is unbelievable stuff. Medicaid planning is the sophisticated way of making yourself poor. There's actually sophisticated ways of becoming poor. What a person could do is they could divest themselves of their assets. They basically had assets, but they did a few things to get rid of those assets. For example, they could gift assets to whoever they want to gift it to their family. They could also place assets into an irrevocable trust, specifically irrevocable, because if you get a revocable trust, then Medicaid is just going to require you to revoke it. Last but not least, what they could do is they could convert countable assets into non-countable assets. As I just mentioned before, your primary residence is not countable, but your TSB is countable. What if I take my TSB and use it to buy a primary residence? Well, you just converted a countable asset into a non-countable asset. Very, very creative. Very creative. So what this means is if you divest your assets, you gift it away, you put it into an irrevocable trust, you convert countable to non-countable, you could then approach Medicaid and say, Medicaid, I have no money. Can you help me? Now, they may say to you, what about all those assets? Not mine anymore. So then you'll be eligible for Medicaid assistance. However, in order to do this, you have to do so before the look-back period. The states are getting smart. The reason why they're getting smart, by the way, is because their Medicaid programs are on the verge of bankruptcy. It's very, very scary to see how many states their Medicaid programs are about to go bankrupt. It's not cool. It's very unhealthy, actually. So the Medicaid programs have been getting smart, and what they've created is a look-back period. They're going to see, did you divest your assets within the past 3, 5, or 7 years? It's going to vary state by state. And if you divested assets within the past 3, 5, or 7 years, I'm sorry. You're not going to be eligible, or those assets will be held against you for Medicaid qualifications. By the way, as I mentioned, federal employees are probably not going to be eligible for Medicaid. But when I'm having this conversation, don't just think about yourselves. Does anybody here have aging parents that are getting older? Maybe they could be eligible for Medicaid. Maybe they would benefit from Medicaid planning. That's something you want to speak about with a Medicaid planning attorney or an estate planning attorney? They'll usually be more versed in these conversations, especially on a state-by-state level, because, again, Medicaid qualifications vary state by state. So let me backtrack a couple of slides, okay? Who's going to pay for your long-term care? Will FEHB? No. Will Medicare? No. Will Medicaid? Not if you're impoverished. Only if you're impoverished, I should say. But otherwise, no. So the last two options are you're either going to self-insure or you have to buy a long-term care insurance policy. And again, the long-term care insurance is not being offered through OPM anymore. So you're going to have to get a policy through the outside. Now, I will share with you guys that when I say self-insurance to people, that means that you have to use your own assets to self-insure. I know it sounds scary. I know it sounds risky, but the truth is we don't have to take any guesses about this. Why can't you measure your ability to self-insure? Does anybody here know how would you measure your ability to self-insure? The answer is actually quite straightforward and quite easy. When you project your financials into the future, which I don't know if anybody here has, but that's the essence of a financial plan. When you project your numbers into the future, you could simulate a long-term care event. You could just create a make-believe long-term care event. When I say make-believe, the math is going to run the numbers. So you could create an event that happens at whatever age you want, whether it happens later in life in your 90s or right away when you retire in your 60s. You could simulate these events. And when we do financial plans for our clients, This is exactly what we do. We simulate long-term care events. And I'm going to tell you guys what we do for our clients. And you guys can do exactly the same thing for yourselves. Here's what we do. We run a 5-year long-term care event. Now remember, the average stay in a nursing home is about 2 years. A person before the nursing home will need some care in their own home. However that lasts, maybe a year, maybe. A 5-year long-term care event is a very unusual event. Very unusual, statistically speaking. So we run a 5-year event, and each year is costing you $100,000. So 100,000 times 5, that's $500,000. And guess what? If you're going to have that event happen later in life, you have to inflate the $500,000. So, for example, it's $500,000 in today's dollars, but if it happens in your 90s, it's going to be much more than $500,000. So, with our clients, we actually run 2 long-term care events, 2 of them. One of them is a long-term care event in their 90s, and the other is a long-term care event in their 60s. Now, let me ask you guys a question. Of those 2 long-term care events, the one that happens in their 90s and the one that happens in their 60s, which one do you think is the easier one to self-insure? Any guesses? Which one do you think is the easier one to self-insure? And the answer is the event in their 90s is easier to self-insure. The event in their 60s is harder to self-insure. And there's 2 good reasons for that. Can anybody guess what are the 2 good reasons why an event in your 90s is actually going to be easier to self-insure? So the 2 good reasons are, number 1, because when you reach your 90s, that means your assets have had additional decades of time to grow. As I mentioned, that in the future, you may not have $1 million, you may have multiple millions of dollars because they had extra time to grow. As opposed to in your 60s, it didn't have those extra decades of growth. So your portfolio in your 90s is likely going to be much larger than your portfolio in your 60s, especially federal employees, as I mentioned, because you guys have those pensions. That's one reason. You're going to have more money in more of a portfolio, larger portfolio in your 90s than you would in your 60s. That's reason number 1. Reason number 2, once you're in your 90s, how long does the money need to last? So it needs to last for you and for your surviving spouse. And if your spouse outlives you, how long are they going to outlive you by? Obviously, we have to see how much younger than you they are. But if your spouse is relatively within the same age as you, they're going to outlive you by what? 5 years? Let's say you want to say 10 years, maybe. So you have a whole bunch of money and it needs to last you for a shorter period of time. As opposed to if you have a long-term care event in your 60s, how long does that money need to last? Well, it needs to last for you and for your surviving spouse. And if you have a long-term care event in your 60s and you pass away, that money needs to last for your surviving spouse for decades. So you don't have as much in your portfolio, and the money needs to last for many, many more years. That's why a long-term care event in your 90s is going to be easier to self-insure than a long-term care event in your 60s. If you guys are following me, I'm about to reveal some gold. Here's what I do with my clients, and I want you guys to think through how exactly this plays out and what the various strategies are going to be in each case. So with our clients, we run both those scenarios. So let's call it scenario A, scenario B. Scenario A is long-term care event in their 60s. Scenario B is the long-term care event in their 90s. So we simulate both of those scenarios. And when we run these scenarios, here's what we discover. We actually discover that there are 3 likely outcomes. 3 likely outcomes. Here we go. Outcome number 1. We simulated the numbers, and we discovered that this couple, remember, if somebody is single, if somebody has no dependent children, that's going to be easiest to self-insure. The couple, the one who's trying to preserve money for the next person in line, that's the one that's the most challenging. So I simulate the numbers, and we discover that this couple, they are already able to self-insure in their 60s. Well, if they could self-insure in their 60s, what does that tell you about their ability to self-insure in their 90s? And the answer is, well, if they could already do it in their 60s, it's going to be easier to do in their 90s. So please tell me, for that couple who could already self-insure in their 60s, and it's going to be easier for them to do in their 90s, do they need long-term care insurance? And the answer is no, they won't. If they could already do it in their 60s, they'll easily be able to do it in their 90s. They don't need insurance. They're self-insured. That's what we just measured. Okay, that was outcome number 1. Outcome number 2, stick with me because the gold is coming. Outcome number 2, we simulate the numbers, scenario A, scenario B, and we discover that this couple, they won't even be able to self-insure, not even in their 90s. Please tell me, if they won't be able to self-insure in their 90s, what does that tell you about their ability to self-insure in their 60s? No chance. No chance. If they can't do it in their 90s, they won't have any chance doing it in their 60s. Well, what does that couple need? They're going to need a long-term care insurance policy. Yes, they will. That was outcome number 2. Now, for outcome number 3, I simulate the numbers, and this couple, they will be able to self-insure in their 90s, but they just can't yet self-insure in their 60s. They will be able to in their 90s, but they just can't yet self-insure in their 60s. Please tell me, what does this couple need? And the golden answer is they just need time. Time. What do I mean time? What I mean is they can't yet self-insure in their 60s, but eventually they will be able to self-insure. So they just need the time to grow their assets so that when they reach that magic age, whatever that magic age may be, it probably will be before age 90. I typically find it's going to be in their 70s that they're self-insured. But whatever that magic age is where they become self-insured, they just need the time so that their assets could grow and reach the point of self-insurance. Well, if they only need time, could someone please tell me, how can I buy time for this customer? So you may be thinking, Stefan, is there such a thing as buying a long-term care insurance policy just for a short window of time? Yes, you could always do that. You could buy a long-term care insurance policy just for a window of time. But what if I told you one sweeter? What if I told you you could use a term life insurance policy as your long-term care strategy? What? Life insurance as a long-term care strategy? That's what I'm saying. And I never would have said this on my own. But once I saw the numbers play out, it actually makes perfect sense. Because if you think about it, when a person has a long-term care event, it's very expensive. So it's going to be depleting their assets. And then when they pass away, now there's less assets for the next person in line, for their surviving spouse. But what if a person has a long-term care event, they deplete their assets, and then they pass away, and that triggers a life insurance payout? The life insurance could replenish the assets. And now there is money for the next person in line. Are you guys hearing this? You could use a life insurance as a long-term care strategy to buy you the time to grow your assets, to become self-insured. And the reason why this is so sweet is because, can anybody guess what's less expensive? A term life insurance policy or a long-term care insurance policy? Well, if anybody here has done any form of shopping for long-term care, you may have discovered it's quite expensive. If you want to get a long-term care insurance policy in your 50s, it's going to cost you about $2,000 a year per spouse. So that's times 2 spouses. That's $4,000 a year. If you're going to get in your 60s, it's going to cost you $4,000 each, maybe even $5,000 each, depending upon where you are in your 60s. If you wait till your 70s, let's see if you can even qualify once you're in your 70s. It's very, very expensive. So if you got a long-term care insurance policy, it's going to cost you like $2,000. If in your 50s, it could cost you about $2,000 per person, as opposed to a life insurance policy that might cost you half of a long-term care policy. So it costs you half, and it allows you to let your assets continue to build. If something happens, you've had a long-term care event, so your assets are able to build until that point, which you've measured that you're self-insured. So you carry a life insurance until that point. Let's say, for example, you retire at the age of 60, and you're going to be self-insured by the age of 75. You have a 15-year policy. By the time you're age 75, your assets have projected to grow and become self-insured by then. This is unreal. And I'll tell you something very interesting about this. Using life insurance as opposed to long-term care insurance, you may find, now this is not common, this is very unusual, but I will say I've seen this a couple times. You may even find instances where somebody's medical condition makes them uninsurable for long-term care, but they are still insurable for life insurance. I'll give you a great example. Rheumatoid arthritis. Now, as far as life-threatening, it's not as life-threatening, but it is very debilitating. So it's a bigger threat for long-term care underwriters than it is for life insurance underwriters. If you think about it, just think, what are the underwriters thinking? So a life insurance underwriter, they're thinking to themselves, okay, we don't want this person to die. Just don't die. Whatever you do, don't die. Live as long as possible. If you need to go to a nursing home, go there and stay there as long as you possibly can. Just don't die. That's what the life underwriter is thinking. What's the long-term care underwriter thinking? Please die. Die right away. Don't go to a nursing home. Just die as fast as possible. So their underwriting considerations are very different. And that's why you have these unusual situations where somebody will not be eligible for one, but they'll be eligible for the other. I will tell you, self-insurance may be the wave of the future. There are a number of telltale signs suggesting that self-insurance is the wave of the future. Let me share with you just a few of them. The first I already shared with you. The biggest companies in the business are exiting the business. MetLife, John Hancock, Genworth, the number one, exited. I also mentioned to you, Medicaid. It's a major sponsor of long-term care if you're eligible, but guess what? Medicaid is going broke. There are, I want to say 40, I think it's 42 of the 50 states' Medicaid programs is on the verge of bankruptcy. So Medicaid's going broke. Many insurance companies are giving patients or giving insureds runaround. So when you try to make a claim, they give you a whole runaround, and they make it very difficult to make claims. I think some of you may have even encountered that with your own parents. When you try to make a claim, they made it very, very difficult. Some of these companies are just raising rates through the roof until the point it's going to become prohibitive, like the federal long-term care insurance program. So if they keep on raising your rates, at some point you might have to say, Stefan, maybe I should just stop paying the higher rates. Maybe I'll just pay my current rate and accept a lower benefit. Isn't that going to leave you exposed? Yes, and whatever exposure it is, you might have to come out of your own pocket for that. That's called self-insurance, when you come out of your own pocket. Also, there's another trend in the industry. It's something called aging in place. Has anybody here heard of aging in place communities? Aging in place communities, very, very popular. The way these communities work is you have to buy into the community and pay their monthly HOA fee. But don't worry, if you ever need long-term care, they have every amenity built into the community. This way you never have to leave the community. You can age in place. But let's pay attention to the numbers. If you're buying into the community, let's say you buy a condo. The condo is usually like a one-bedroom condo, maybe a two-bedroom condo. How much is that condo going to cost you? It should cost you $300,000, but to get into this community, you have to spend $600,000. And then there's the monthly HOA. How much is the monthly HOA? $500 a month? No, it's going to be like $1,500 a month. So you're overpaying to get into the community. You have a super high HOA monthly, but don't worry. If you ever need long-term care, we have all the amenities built into the community. Please tell me who's paying for that long-term care. That's you. That's you. By the way, if you want to set aside, if you want to buy into a long-term care benefit, you could actually buy long-term care benefits by putting a lump sum of money in. It's very, very common. People utilize life insurance, not just term life insurance. Some people use a whole life policy. It's a single premium. They just put a bunch of money in, and this way they know that they have a life insurance policy. The life insurance policy provides a long-term care benefit. So if you need long-term care, the life insurance company will pay you out. And if you don't need long-term care, there's a death benefit. However, remember, that's a whole life policy. That's a policy that lasts your whole life. That's not a term policy, what I just described. That's a whole life policy. And a whole life policy, for anybody who knows how whole life works, they usually just pay you back the money that you pay in, the money and the growth. So basically, it's your money that they're paying back, unless you die young. Right? But that wasn't on your agenda. And if it was on your agenda, the term insurance would have been better off anyhow. So I will tell you guys that there are many, many arrows suggesting that self-insurance is the wave of the future. I think some of you guys are detecting that now that the federal long-term care insurance program has shut doors. Now, if you want to get long-term care insurance, you're going to have to go to an outside company. And as I mentioned, there are not too many of those companies. There are some. I mean, we still help clients land long-term care insurance policies. So as I mentioned, anybody here who needs help thinking this through or landing a policy, you can always click that button on the right side. I'm happy to help you think it through and strategize the long-term care plan. And if you need help on the insurance side, we have an insurance team that can help you land. If you don't self-insure, then their last option is to get a long-term care insurance policy. I want to see if you guys can self-insure, because if you get a long-term care insurance policy, it's going to cost you a lot of money, 100 plus thousand, maybe even hundreds of thousands of dollars. Again, I'm not saying you shouldn't do long-term care insurance. It could very well be that's your only option. But what I am saying is that it's super expensive, and we could probably help you figure out whether you need it or not. So I've been speaking a whole bunch. I know I'm coming close to the end of the hour. I will mention that the federal long-term care program is gone. There are some benefits that you could never have gotten even in the federal long-term care program. Okay, what are those benefits? So I'm not going to spend too much time right now. I'll just mention a few of them. There's something called a shared care benefit, which is basically if you have a husband and wife applying together. What that means is they're each going to get their separate policies, but there's a way to link their policies. This way, if one of the spouses needs long-term care and they exhaust their own policy, they could tap into the benefit of the other spouse. So that actually is a way to structure long-term care policy. There's also weekly and monthly reimbursement, what the federal long-term care program is not offering. Medicaid partnerships, I'm not going to get into. Life insurance riders, I mentioned before. And then there are more deductible options. The federal long-term care program, when it was in existence, it was offering a 90-day elimination period, a 90-day deductible. If you want to save money on long-term care insurance, raise your deductible. So instead of using 90 days, you could use 100 days, you could use 180 days, you could use 365 days. That really, really reduces the price of a long-term care policy. Now, as I mentioned before, anybody here has questions about what we discussed today? I'm happy to answer some questions now, but if you want to have a one-on-one conversation, just click that button on the side where it says learn more, and you can request a one-on-one consultation with me. Okay? I will let you guys know that if for those who need an immediate consultation, I'll have someone from my team be able to meet with you sooner. I'm actually not meeting people for a few months. However, I am just because my schedule is booked out all the way to May. However, I will say that if anybody here wants to meet before then, I will definitely have a member of my team schedule a time with you. So I see a couple of questions in the chat box. Let me go to the questions that are waiting for me in the chat box. Okay. So Michael's asking, have you heard anything from OPM or the insurer that they are going to greatly hike rates for existing policies? So I heard murmurs about this. I heard something about May 2023, a price hike. I tried poking around just to see if I got any details. It just right now seems to be a speculation. I don't know if it's anything solid. I see another question. Stefan is asking in the chat box. I have the federal long-term care. Should I keep it or should I look at the other options you've mentioned? So Stefan, I think you should be looking at all your options. If you stick with the federal long-term care program, just understand it's going through major changes. you may be shocked when they come back and they once again double your premiums. That is a possibility. Now, I don't know if it's going to happen, but I'm just saying, like, this is they may just have the ability to raise rates for the next for the foreseeable future. So I want to see if you guys even need the long-term care insurance, and if you do, do you need long-term care insurance for the rest of your life, or do you just need it for a small window of time? So Janice is asking, what are the elements to include in the 60s and 90s long-term care advantage simulate? So Janice, it's going to be 5 years. Each year is $100,000, and you have to adjust it for inflation. So again, if you're having an event in your 90s, so you could start it at the age of 85 and you're dead by 90, or you could start at the age of 90 and go to age 9 and you're dead by the age of 95. But it's a 5-year event, $100,000 each year, adjusted for inflation. Okay. So Jim has a question. Can I receive a link to see the last class on the TSB G Fund options? Thank you. So Jim, I have an article about the G Fund. So if you guys have not seen my article, I know many of you are concerned about the G Fund being suspended as a result of this whole debt ceiling. I will let you know, do I think that they're going to extend the debt ceiling and then, make good on the G Fund? I think they will, because that's just historically what usually happens. So I think they will, but I have pointed out in my article that even if they do restore the G Fund, you still have better options outside the TSB. So if anybody here is interested, you can check my website for my recent article about the G Fund, and I can tell you what we do for our clients to help them recreate the G Fund outside the TSB. Sean is asking, if you are single, then this drawdown and replenish plan would not work. Sean, if you are single, then you might not need to have a life insurance replenished, because who are you replenishing assets for? Who's the next person alive? We're talking about somebody who's single. So do you have a dependent child, or are they already independent? If they are independent, so then you're probably self-insured. Okay. Fantastic. I see. Okay. I see a few people. Sean is asking, do you do planning for those looking to move out of the country in their retirement years? I have some clients that have already moved out of the country. So I can't speak for every single country. I don't know the tax laws and some of the implications. But as far as preserving Social Security, you could do that. You could preserve your Social Security even if you live in another country. As far as your health insurance benefits, so that's where you have to see whether your health insurance carries over to another country. Some plans are recognized outside the United States. So yes, we do have clients that have moved out of the country. Okay. I see that there are a few more things. Yes. Wow. I see some people are saying that they didn't even realize that the federal long-term care program was being canceled. They just heard it from me. Unbelievable. I'm sorry to hear that. But that's why I'm here. I'm here to be a resource to you guys. And again, these classes, they do not happen in a vacuum. They happen because I have people who are supporting me. If you want to become one of those people who support me, if you want to become one of my clients, one of my members, you can check out my website. You can also request that meeting. As I mentioned, me personally, I'm not able to meet with people for another couple of months, but I could definitely have somebody on my team meet with you to discuss federal benefits, long-term care, retirement, all that good stuff. Fantastic, fantastic. I really appreciate you guys sticking with me. I hope you enjoyed today's class, and I hope to see you at some date in the future. All the best. Have a great day.